Welcome back to News 5 at 9. It's 9:09. Mark Davidson's joining us today from Cornerstone Investments. Today we're talking about understanding what you call risk tolerance. First of all, define what that is and why it's so important to know.
In essence, it's how you are able to emotionally withstand the ups and downs in the marketplace.
Why is that important, though?
Well, in the past month, we've had kind of a roller coaster ride. We've had, up 200 points, down 200 points, down 300 points, and on and on like that for the entire month. So it's been a challenging month, and a lot of people have been questioning whether they're in the right investments.
Very good. Okay. And so how do you actually know? What do you start looking at to figure out if this is truly where you need to be investing?
It's kind of a qualitative process in some senses. There are a handful of things that we encourage people to look at when they get started. First is, what's the objective for the money that you're investing? If you come to me and ask me, hey, should I invest in Coca-Cola? We've got to know the answers to these questions before we can assess whether
Meaning,
that's
is this retirement, or is this just something you're doing for immediate extra income? I mean, I'm assuming all of that comes into play.
If you're saving for a down payment for a house, you don't need to be invested in risky investments if you're planning on using that money in the next 2 to 3 years or so.
And that's where the time frame, I guess, comes in, when you're actually going to need to see some profits from your investments.
If it's college savings, it's one thing. If it's retirement, it's another. If it's saving for just extra money, it's an entirely different matter. So time frame is important.
Also, you say how it all kind of juggles and balances with your other assets. What assets do we need to be concerned about?
Well, obviously your house is most people's biggest asset, but I'm more referring to other assets in the portfolio. One stock by itself does not a portfolio make. So you've got to make sure that the addition fits with everything else that you've got in there.
So you don't want 100% all high risk.
Exactly.
Okay.
Exactly.
Also, it's important too, you say, and we were talking about risk, your ability to accept risk, and I'm assuming, I would think emotionally and financially, you kind of tie all this together for this?
Right. An example is, what we're talking about when we talk about risk is volatility in return, and that means the ups and downs of the marketplace. For example, if you have an investment that earns 8% one year and 8% the next, you get 16% roughly total. At the same time, if you have an investment that goes up 25% and down 7%, you've also got 16%. Presumably, the second investment would offer higher returns over time because there's more volatility associated with it. But the question is, how comfortable are you with that volatility? And that's what we're trying to assess.
And I always hear people in a restaurant or wherever, or in the newsroom here, when you hear the stocks going up and down, there are certain people that are worried and certain people that just say, oh, it'll bounce back.
Right.
And I'm assuming that's kind of what we're talking about here too. Now, when we talk about market experience, just mean the longevity that you've actually been in the market? Pretty
much. If you have been investing for 5 to 7 years, you have an understanding that there is, going to be a down at the same time you experience ups on occasion. If you've been investing for 6 months, you might just assume that the market only does this over time or only does this, kind of extrapolating most recent experience. So we want to know how much experience somebody has with the market and how much comfort they have with those ups and downs, because at the end of the day, the first thing we're trying to do is we're trying to assess somebody's comfort level with risk. If we can't do that, and if we can't adequately match their risk tolerance with their investment portfolio, then they're not going to be able to sleep at night, and we're not going to have accomplished the job that we need to.
And at what point do you think in someone's investment, needs and their portfolio, at what point should you actually say, maybe I do need to seek some professional help to get someone to help me manage all of this?
There are a number of times that you can. It really depends on your comfort level with what you're able to investigate and understand. If all of this sounds like Greek to you, you probably need to seek investment advice sooner rather than later, because frankly your retirement depends on it. We've moved from a system where we had defined benefit plans where you were going to receive X amount each month upon retirement to a situation where everybody's kind of planning their own with a 401k plan.
Better safe than sorry. You're exactly right. And if you have questions about what we talked about today, or questions about maybe whether or not you should actually seek some professional advice for your portfolio, call Mark at 626-6992, and that'll get you in touch with Cornerstone Investments. Thanks for joining us today, Mark.
Thanks, Jennifer.
We'll be right back.